Good morning. Good morning, good morning. Wow, to be back in college. How many want to never leave here? I see a couple back there. How many want to get out in the workforce sooner rather than later? Okay, you got a couple. Seems a guy back there with the tie on. I should have known that, right? You look good. Hey, I really appreciate the opportunity to come and speak to you all today. We have a real neat little cog, sort of a cog in the wheel of finance, and I'm going to talk to you all today. It's called surety bonds. And how many have ever heard of a surety bond? Okay, a few of you. My goal today is to kind of go over a little bit about what the bonds are, and I'm going to kind of go broad at first and get a little bit deeper into contract surety bonds, which kind of focus on the construction industry, was really where these are used. My goal is really, because I was thinking, who is my audience today? And one thing that you guys will learn when you're giving a presentation in the back of my mind was, know your audience. Who are you talking to? I'm talking to bright young college students that are interested in business. And my goal today really is to try to introduce you to this concept that hopefully in 20 years, when you're in the surety bond business perhaps, you're working for an insurance company and you're an executive and you look back and you say, somebody asks you, how did you get into the surety bond business? How did you ever learn about this? And you'll look back on this Friday and you're thinking back to this guy in a purple tie when you'd probably rather be at TJ Rockwell's now. But you're listening to a lecture series, and this guy came and talked about surety bonds and really opened my mind up to the world of finance. Maybe you're going to get a finance degree or an accounting degree. You're not sure where to go. The only thing you know is maybe to trade on Wall Street or a business analyst, whatever. But hopefully we're just going to introduce you to a concept that you're going to be somewhat interested to. And one thing that I think is valuable just to keep in mind for college students and just anybody is, especially in this world today where the knowledge worker is really excelling and the generalist, I think, is being kind of worked out of the workforce. The more specialized you can be, hone in on sort of one area that you're passionate about, the more successful you're going to be, the more valuable you're going to be to employers, when you start your own business, especially in the world of finance. There's a lot of neat little niches, okay? All right, what is a surety bond? There are three parties to a surety bond, okay? The principal, the obligee, and the surety. And I'm going to give you just a quick example here. Let's say I promised Dr. Williams that I would take him to the Berks Jazz Fest, all right? And that I promised him ahead of time we were going to do a catered party at his house. We're going to bring in a caterer. We're going to get a limo to the event. We're going to have a nice little event ahead of time, okay? And he looks at me and he says, that sounds great. He makes all these plans. He brings maybe some clients in, some other professors, and he's really looking forward to this date. And he says to me, you know what? That sounds great. I'm not sure if I can really count on you to come through on your word, all right? So what I'm going to do is I need some kind of guarantee that you're going to take me to the Berks Jazz Fest. You're going to pay for all the stuff. You're going to get the caterer. And I say, really? And he's like, yeah. Okay, you've done this to me before. You've bailed on me. I need some assurance. So what he says, can you get a guarantor? So I say, sure, I'll get a surety to come in and guarantee my performance. So in other words, we call some guy with money and he says, sure, I will guarantee that you will provide your services to Dr. Williams. You'll take him to the Berks Jazz Fest. You'll pay for the vendors. You'll do everything. You'll pay the limo. You'll do everything. Now, for that right, for that guarantee, the surety is going to charge me, let's say it's a $10,000 party. the surety is going to charge me $100, okay, for that guarantee. I'm going to pass that cost on to Dr. Williams. Say, okay, I'll get you a guarantee that I'm going to do what I say, but you're going to have to pay me $100. Does that sound fair? Yeah, I'm willing to pay that premium. So we pay the guarantee. So in this instance, okay, I am the principal. I'm the guy that has to perform what I say I'm going to perform. Dr. Williams is the obligee. It's just Latin for basically for owner, the person is obligated to get what I say, okay? And then this guy, in most cases, it's an insurance company, but sometimes it can be an individual with a lot of money. So he guarantees. So if I don't perform, then this guy has to pay for the limo, has to pay the caterers, make sure that I do what I'm going to say I do. If I do perform, and I take Dr. Williams to the Jazz Fest, we have a great time. We paid $100 for that guarantee, but then the surety gets that $100 premium. All right? It's a three-party contract. Any questions there? All right. Now, I'm going to kind of go into, actually, let me back up here a second. There are cogs that underpin all of the financial world. Bonds are everywhere. In the legal system, in the transportation system, in the international finance, in the commercial surety world, for instance, in the legal system. If you're under 18 and both your parents die and an estate's left to you and you have a guardian, there's a guardian bond that needs to be posted to the court to make sure that the guardian is going to take care of the funds, make sure you get to college, you're paid, your housing's paid. There are commercial bonds, for instance, where let's say you're a company that hauls fuel, okay? And you buy and sell fuel all the time and you owe taxes on that fuel. Well, those tax obligations can be very large. So companies will come to me and say, I need a bond for my fuel tax payments. So what they do is they'll put up a bond to the state that says, hey, you've bought and sold thousands of gallons of fuel, you owe X amount of tax, you better pay your taxes. If you don't pay your taxes, they can pull off that bond. Okay, so basically it's a guarantee that underpins a lot of the financial world. It got AIG, and you guys heard, the crisis and everything that happened in the crisis. Well, in the financial crisis, this thing melted down because insurance companies are really the guarantors of a lot of these different obligations because they have a lot of cash on their balance sheets. They're very strong financially. What happens is they were guaranteeing that companies were not going to go out of business. So somebody would buy bonds or invest in a company, and then AIG would say, hey, pay me a premium, pay me $10 million. And if this company you invest in goes out of business, we'll pay you your principal back. And that works out great. If nothing happens, they get rich, they get a lot of that premium, okay, and they were making a lot of money. What happens, companies started to go out of business, they had to start making good on their guarantees. So this world is very broad in the financial world. I'm going to talk more a little bit about, probably go into a little bit deeper on construction and contract bonds, which are really where the lion's share of this works and where it is mostly where the bulk of the premium is in the construction industry, okay? And around here especially. So in the construction world, there are three types of bonds. There's a bid bond, a performance bond, and a payment bond. So when a general contractor goes to bid, let's say you're building a road for PennDOT or a bridge, they go to bid this job, and they bid $100 million job to build this new road or bridge. They have to put up a bid bond, which basically guarantees that if they're low bidder, they will perform and they will enter into that contract and they will be able to get performance and payment bonds on that job. So they're low bidder, they bid $100 million, they were the lowest on the job. they now have to submit performance and payment bonds on that job. A performance bond basically says that you're going to perform to the contract without any problems, and then attached to that is a payment bonds, which protect all your subs and suppliers, all right? So your subs on the job, you have guys providing you asphalt, crushed stone, the labor on the job, anything, the bridge painting, anything under the general contract, you have promised to pay all your subs and all their suppliers and even their subs. So essentially what it does is it wraps up and it guarantees that the performance of a job, okay? They were having troubles back in the 1800s where people were getting jobs, they weren't performing, they weren't making good on what they were doing. The federal government instituted something called the Hurd Act in 1894, which basically put this language into place where like, hey, when there's public money involved, we need to make sure and guarantee that these things are going to get done, all right? Then the Hurd Act kind of morphed into something called the Miller Act in 1935, which basically took a lot of the Hurd Act language, incorporated in the Miller Act. Now all states and local municipalities in Pennsylvania and every state in the nation have instituted these things called Little Miller Acts, where essentially basically adopts the federal laws, okay? So your tax dollars at work here to make sure that these projects are going to be built. Now, insurance companies are the ones that guarantee and sell this product, okay? They have a lot of cash on their balance sheets. They're used to transfer of risk, which is what this is. Now, surety bonds are different than traditional insurance because of a couple things. And I want to point out a few things here. Oops. Surety bonds involve three parties, like we talked about earlier, okay? Insurance is just a two-party contract. So, and there's a really big distinction here. Surety bonds are underwritten like a financial loan when you go to get a loan from a bank. When you pay your car insurance, okay, you pay, $300 a year, $600 a year for your car insurance. You have an accident that causes damage of $1 million. Well, you've only paid $600, but the insurance company pays out $1 million, all right? Now next year, your insurance is going to go up, but it's not going to go up to $1 million. Now you may get canceled by your insurance company, you have to find somebody else, but your premiums go up a little bit because of the accident. But you're still going to be able to get insurance. In a surety bond, if you cause a loss, just like a loan, if you cause a loss, you guaranteed a $100 million contract to build a bridge, you couldn't perform the contract, you didn't pay your subs and suppliers, the insurance company had to come in and underwrite the project again, get another general contractor in, you went out of business. You're on the hook. Your business is on the hook. You sign a guarantee with the insurance company, and also your personal assets are on the hook most of the time. So you as the owner of the construction company or the business getting a bond has to sign personally. If you cause a loss, you have to indemnify, is what the insurance companies call it, the insurance company for their money back. So you cause a $15 million loss, you're going to have to somehow come up with $15 million, hopefully. And that's where it's a very risky business for the insurance companies, and the underwriting, we're going to get into that a little bit, is very strict because these guarantees and these companies, the insurance companies, sit outside of the ring of protection from the banks. They're on the very outer edges of the security. And in the world of finance and banking, banks lend money to companies, but they have security. They have, liens on assets and liens on personal residences and things sometimes. Surety bonds sit outside of that, are really unsecured credit, okay? we see a bunch of private owners now becoming interested in bonds because of the economy. We'll talk about that a little bit more. Any questions on that? Okay. Now sort of my role in the process is as a producer right here. I sit in this wing, sort of in this ring with all lenders, with attorneys, with some CPAs right in here as kind of the contractor's advisory group. And I basically relay information and pre-qualify contractors to the surety company, okay? And this is an ongoing process, especially when you have a new, and again, I'm just using a contractor as an example. You have a new general contractor wanting to get into the business. They need guidance from a producer like myself and from the surety company of how to structure their balance sheets. Are you guys learning about balance sheets in any of your classes? Right? Yes? Okay. So you know what a balance sheet is, the statement of assets and liabilities and net worth of a company. Surety companies look at balance sheets very strongly. They really look at how strong your company is with your net worth and with your working capital ratios. Can you qualify for a bond, and will you be able to perform and do the work that you say you're going to do? So this is a very important role in the process. Now, I'm going to talk a little bit about the pre-qualification process, because in light of who the audience is, this is something where you as a business student, like numbers, accounting, finance, surety companies, they're mostly insurance companies, are always looking for good people, and it's a little niche out there. They're looking for people to pre-qualify construction and other types of companies, okay? And to get in and they have a job, the job's called an underwriter. And essentially you get all this information that I would give to the underwriter. You gather financial statements. I would gather references, credit history. We look at the capacity. Can the companies perform the work they're going to say they're going to do? Can they deliver on their promises? Look at the organization. So these underwriters look at the organizations, they crunch all this data, and they really analyze with ratios, hey, is this company a good company? Can they do what they're going to say they're going to do? All right? Take a deep look at the banking relationships. Are their assets secured? Do they have working lines of credit? How are they able to perform? Are they paying their loans back? This is all the role of an underwriter in a surety department of an insurance company. They really go heavy on analysis of the financial statements, okay? Is this, when you're looking at a financial statement, is it a compilation? Is it a review? Is it an audit? Those are different levels of financial statements. How does the balance sheet look? You know, surety companies and underwriters look very, very, very heavily on working capital and net worth. And working capital is essentially the money left over after you take your current assets and you subtract out your current liabilities. What's that number left? What's the cash you have in the availability of the company to work with, to make sure you're paying your bills, to buying supplies? What do those ratios look like? Is your balance sheet strong? Do you have good net worth? After all your bills are paid, after everything you owed is paid out, what is left in the company? Okay? Is there cash flow coming in? A lot of cash running through to pay debt. Are the account schedules current? So you as an underwriter would look at, are your accounts payable? You know, you owe people a bunch of money. Well, do you owe people, is it 120 days out? Is it 90 days out? Are you paying your bills? If you have accounts receivable out there, are people paying you in a timely manner? So these are all things that underwriters are looking at. Is your overhead high? You know, do you have a lot of the general and administrative expenses really talks about what does it cost for you to keep your lights on, to pay your people? Are those numbers out of whack? Are you, do you have profitable contract schedules? Are the jobs that you're working on, are they profitable? Are you getting them done in time? Are you making good gross margin on all your jobs? Are you a solid company, all right? And I go into this a little bit because this is kind of what the job of the underwriter is, and they really do a good job, and they really sit down and analyze companies, working with the producer like myself, going out to visiting contractors, other companies, sitting down with them, getting to know them, really digging deep inside their business. Because remember, this is a credit-driven product. It's not an insurance product per se. It's a financial credit product sold by an insurance company. So the credit analysis is very important here. Now, what we're seeing is, lately anyway. You're good. Okay. What we're seeing lately is, while this product in the construction world was primarily for public funds, everything that has a public fund, a wastewater treatment plant, a bridge, a road, anything where there's public money involved, these are mandatory from about $150,000 or more. But what we're seeing this industry really sort of bleed into the private industry a lot because of the markets out there right now, the economy, things aren't going that well. The economy's been shaky. There's been a lot of defaults, a lot of contractors, a lot of businesses have gone out of business. So we see a lot of private jobs, like private office buildings, warehouses, things that typically owners would not have required bonds or requiring bonds now because of the economy. So the product is becoming a lot more well-known and a lot more utilized in the private industry. So you go along and you see things being built right now. A lot of times those products have a bond element to them. Okay? It really provides financial security and construction assurance that everybody's going to get paid on the job. Now, one thing too in the private world where we're seeing is these liens are a big deal in private world. In other words, what that means is if you're a private owner and you're building a building, the subs and the suppliers on the job, if they don't get paid, they can put a lien on the building. In other words, there was a dispute. It's you said this, no, I'm right, you're right. A sub or supplier can throw a lien on a project. And what a lien does is, in order for the owner to take ownership and possession of that building, those liens have to be released. They have to be paid before the owner can take ownership of a product. What happens is sometimes these things can be messy for a long, long time where a sub or supplier wasn't paid, they put a lien on a building, and the bank and the owner can't take ownership because this guy wasn't paid, the attorneys are involved, it gets to be messy. With a bond on the deal, you can avoid liens because a bonded job is not allowed to have liens on it, which is a nice thing now that the private world is beginning to find here. So what this does is this creates a smooth transition from construction financing to permanent financing because the owner then can take ownership of the building. What it does is these are really meant to ensure the project completion. Now for a fee. Now remember when I said earlier that there's a fee involved here for that guarantee. It's typically, let's say 1% of the project cost is the premium paid for this product. What's interesting is I was actually doing a little bit of research last night, and the first bond was actually instituted back in 2750 BC, and they found a contract written on a clay tablet. So these, and then the Romans kind of instituted bonding from about that time on to, and they started writing down laws in about 600 BC. So this method of guarantee has been around for a very, very long time. Okay. Just a little bit of the cost structure. A bid bond it doesn't cost anything, is not charged. A performance bond there is about 0.5% to 2% of the contract price. And then when I was talking about the payment bond is basically included in the performance bond language. So essentially when a contractor goes to bid a construction project, this is all included. Okay. Okay. Great. I believe that's the last slide here. Yeah. Any questions on anything? Is this something that interests any one of you? Good. Yeah, go ahead.
How did you find something like this?
Yeah, that's a good question. I was in the banking industry for a long time, and I just kind of really wanted to, like I said earlier, I really wanted to find a little bit more of a niche, sort of as a career, because I thought that was important. And I met a gentleman that owned an insurance agency a number of years ago, and they really wanted to grow this practice. And they needed somebody with sort of a financial background, basically, that understood how to read balance sheets and income statements. And they really wanted to grow this practice, so got involved there about 5 years ago and really started to grow the practice, and it's been good. But it's a world that's really, it's never going away. It's about a $30 billion a year business for insurance companies. And it's extremely profitable niche for insurance companies because the loss ratios are typically maybe about 30%, okay? So if they take in, $100 million a year in premium, about $30 million are maybe paid out in losses, and then the rest are profit. So it's a very profitable industry, and it doesn't take a lot of manpower to make this work. So insurance companies are always looking for people to you kind of begin as an underwriter, and you sit and you analyze the financial statements and do everything, and then you can sort of grow into maybe handling bigger accounts, and then a lot of people go into then chief financial officer positions at a construction company. They get into what I'm doing on the producer side, where they go try to find businesses and construction entities and just businesses in general that need bonds and bring them to them. Or some of these begin their own agencies. Some actually go into accounting afterwards, but it's a really good skill to have, to be able to analyze financial statements and really know your way around a balance sheet and an income statement is a very useful tool to have if you want to be in this world. Or just any world, actually any business role. It's a very good skill to have. All right. Thank you.
I have a question
Yes, yes, who pays the LG. If the system breaks down and the construction company or the company can't perform, is that what you're asking?
Yeah.
Yeah, then the insurance company, which is the surety, okay, this is the insurance company right here, all right? And then this, let's say, would be the general contractor or the person performing. This is the person that needs the object built, the road or the bridge. This could be a municipality or whoever. Now, so if this breaks down, if this person can't do it, then the insurance company either pays the owner directly the remainder of the contract, or they will guarantee, let's say these guys just get into financial trouble. They will guarantee maybe an extra bank line. They may give them another couple $1 million to sort of prop them up to finish the job, or they may bring somebody else in there altogether to finish the job. There's a project downtown Lancaster where they were building the Red Rose parking garage. Red Rose Transit Authority was building a parking garage. The general contractor defaulted on it, and it stood there forever. The guy he had too much work going on. He was robbing Peter to pay Paul. He couldn't finish it, got into financial trouble. So the insurance company brought in paid to have another general contractor come in and actually finish the job. So it's all on them. So while they may get, for a $100 million job, they may get, $1 million to issue the bond. Well, if nothing goes wrong, then that's great. They get $1 million as premium. If something goes wrong, they have to spend millions and millions and millions of dollars to fix the project. So it's definitely a risk transfer mechanism, and there's a risk and reward there. Yeah. Okay. Anything else? Okay, thank you.